Investing on the stock market is not necessarily about picking the winners, but rather avoiding fundamental mistake and getting a decent return in the long run. And here are 10 tips I wish someone told me before I started investing. Number 1, find yourself a reasonable and reliable stockbroker or trading platform. So this is where you're going to do all your buying and selling of shares. And if you find a good one, it can save you a lot of time and money in the long run. I would look for one with cheap prices, fast transaction execution, good customer support, both on chat and by phone, and maybe even a good and user-friendly design. So it's easy to get an overview of all your investments and all your activity and analytical tools. Number 2, start out with ETFs and blue chip companies. So you're not in a rush for returns in the stock market. And the most important thing is to participate. And these are your safest options. ETFs are mostly index funds. Blue chip companies are the biggest, most well-known and established companies. This way you can get a decent return at a low risk. You can always turn the risk up a few notches as you become comfortable with the ups and downs of the stock market. Number 2, do not try to time the market. All statistics and studies shows that if you try to wait for the right time to invest, you're only going to lose out on returns in the long run. And I made a video a few weeks back where I show that even if you time every single stock market crash perfectly and you invest at rock bottom, you're still going to lose out to buy and hold investors. Number 4, invest as much as possible. So every dollar counts, especially when it on average will double in value in less than 8 years at an average return. And if you invest $10,000 by the time you're 25, that can turn into $320,000 by the time you're 70. So get started, get going, invest as much as you can. And another tip, to avoid having to sell your investments, make sure that the money you invest is money you don't think you will need for the foreseeable future. Number 5, invest regularly. So whenever you have savings saved up, put it to work in the stock market. Don't let it sit in the bank and rust away to inflation. Whether the market is going up or down doesn't matter, just put all the money to work. If you get stuck on the sideline, you're very likely to lose out on returns in the long run. Number 6, shut out the news. Whatever happens, completely irrelevant to you as an investor. The problem with news is it's number 1, sensationalized, so it's made much bigger than it already is. And number 2, it most likely has no effect whatsoever on the stock market or the global economy. And there's a good reason why we say all news is yesterday news, because once you hear about it, it has already happened and the stock market already know about it and has done what it has to do. So you making moves as an investor based on news is completely pointless. Number 7 goes without saying, do not sell unless you have to. When you sell stocks, you're taking money out of a market where you're getting an average of 8% return a year, and you have to pay between 15 and 30% capital gains tax on your returns, depending on where you live. Now, of course, sometimes you have to sell, and personally, I have sold stocks to buy an apartment, to buy a car, and if I want to invest in a different company. But big purchases, and if you change your mind about investments, should be the only time you sell your stocks. It's very costly to sell, even when you're just taking a little bit of profits, so try and not sell at all. Number 8, don't forget about dividends. So if you're holding an ETF or blue chip stocks, you're more than likely being paid a dividend. So basically interest on your money. It might just be 1, 2 or 3% a year, but that's like 30% of your average annual return. And it's being paid regardless of whether the market goes up or down. So over time, it can actually make up more of your returns than actual price appreciation. And a lot of graphs, calculations, and brokers don't take dividend into account when they show you returns. So I would suggest keeping track of what you've been paid in dividend and what return that has given you, because it's very important in order to be able to evaluate how well your dividend investments have been doing. And you should also check out the dividend before you buy the stock. Number 9, don't be afraid to take risk. Once you get comfortable with the ups and downswings, that is, you know, a portfolio consisting of index funds and the big, most well-known companies is all great. And you can probably get good returns and even beat the average. But if you want some outsized return and take a little bit more risk, I personally suggest adding some smaller growth companies to your portfolio. Even though they just make up a small percent, they can really return you outsized, proportionally large gains. And just like in other, parts of life, those who don't risk anything don't really stand to gain much either. So start out with the safe investments. Once you get comfortable and you're able to keep a level head when things go sideways, you can start finding some growth stocks. Number 10, and in my opinion, the most important tip, invest in what you believe in. The thing is, this will help you keep your head clear when things are going up and down, because with investing, it's important to not sell when things are going down, maybe even buy more when things are going down, and don't sell just because it's going up. And that's a lot easier to do if you actually believe in what you invest in, because you're able to see further ahead and see the light at the end of the tunnel and keep calm when things are going well. And I personally invest in big shifts and trends I see in the world. Examples would be gaming, e-commerce, cloud computing, electrification, semiconductors, and so on. And I'm sure you have companies, industries, or countries or trends that you believe in, and parts of your portfolio, in my opinion, should be things that you are convinced are going to do better than something else. So in order to be a long-term investor and keep your eye on the price, it's important to have investments that you believe in, not just being invested because you think the market will keep going up. Because if it doesn't, what are you going to do then? These are my 10 tips. I think if you follow these tips, there's a 90% chance you'll be 90% investors. I'm not saying I've always followed these tips. At some point, I've probably killed all of those and done the exact opposite. And please do share with me maybe some of your tips that didn't make this list. Of course, we're all a collection of investors, so the more advice we can get out there, the better. Hope you enjoyed this basic video. Got some more stock specific videos lined up for you. Hope I'll see you in my next video. Thanks so much for watching. Subscribe for more videos. And as always, take care.